Welcome back, Joe Brunsman, insurance broker to the stars. Today we're going to be talking about insuring for social engineering type losses. Now, quick disclaimer here. I am not your insurance guy. I am not your attorney. I am not providing official advice in any capacity whatsoever. If you have any questions in any regard, you need to speak with a licensed and qualified attorney. This is a very, very deep topic with many, many subtle details that are very easy to get lost in or just completely overlook. So I'm just giving everybody here just kind of some consideration, some ideas for thought, so that when you go down this path, you at least know kind of where to start and kind of what general questions you should be asking of your own insurance professional or the attorney that you have engaged to assist you with this process. All right, with that, let's go ahead and jump into it. Let's look at the current cyber market conditions and kind of what we're seeing. So for these, social engineering type losses, we're seeing historically low limits or sublimits actually being offered here. So it's not uncommon, even for large businesses, to only get, say, $100,000 in possible coverage or $250,000 in possible coverage here. Long gone are the days where you could probably get $500,000 or even $1 million in coverage for these social engineering type losses. Now, when I say social engineering type losses, there are many, many different terms used to describe this phenomenon. The gist of what I'm getting at here is somehow somebody loses money because of a computer system that was involved. So that could generally be, hey, your business gets tricked and it loses business funds, or your business gets tricked and then you lose client funds. Or a third would be your business gets hacked and then somehow your clients or your vendors get tricked into transferring money there. So, a lot of businesses, they come to me and they go, hey, we could be transferring $1 million a month, or we could be transferring millions of dollars a day. This $250,000 sublimit here, or whatever it may be in their case, that's just not going to cut it. We know this is an issue. What other types of insurance do you think we could look at to potentially cover this type of loss? And with that, there's really kind of two types of other policies that are generally looked at to cover this social engineering type loss. And that would be an excess insurance policy and a crime policy. And we're going to be talking about both of those today. So starting off with this excess insurance policy here, all right, what is it? You have your primary policy. When you exhaust that, then excess comes over the top of it and provides additional limits. Obviously, it is much more complex than that and much more nuanced. But that's the gist of kind of what we think of in the broad term of excess insurance. Now, there are different types. So if you're going to go down this path, you need to be aware of that. There are follow form policies, there's conditional follow form policies, and standalone excess policies. I'm not going to get into the differences between those, but suffice to say, if you're a business owner or you're somebody who's looking into acquiring this type of coverage, you need to make sure you understand what those differences are, because they can have a very, very substantial effect on how they actually operate with your primary insurance policy. Now, if you're trying to get some additional social engineering coverage attached to this, could you get that with an excess insurance policy? Maybe. You may be able to get some sort of manuscript and endorsement to actually drop down on that, all those social engineering type endorsements. Now, what's probably the most you're going to get there? Probably $250,000. It's actually how it plays out. Why? A lot of companies that write excess insurance, they could also be writing primary cyber insurance policies. So they know what the game is. Don't think that you're just going to go in there and get an extra $1 million of social engineering coverage for like an extra $1,500 a year. That's not going to happen. Those days are long gone. So the excess insurers absolutely know what the game is, and that's generally a game that they are not willing to play with very high limits. Now, I was speaking to a brilliant insurance guy that I know who works in this field quite often, and I said, what would happen if a client comes to me and he goes, money is no option. I need $10 million worth of social engineering coverage. What would that cost? And so, after explaining to me that that's probably impossible, he said, if it's even possible, if they would even take that type of risk, you could easily be paying at least $1 million a year for an extra $10 million worth of insurance coverage for social engineering type loss. That's even if the market would play with it. Now, you also have to understand that generally the excess insurance market does not want to engage in something called an overhang. And that means that the excess insurance has more potential monetary liability than the primary insurer has. So don't just think you're going to get like a $1,500, $1 million in limit cyber insurance policy and then get a $10 million excess insurance policy overhang on that. Probably not going to happen that way. You also need to understand that excess insurance is not as simple as maybe the average insurance guy would want you to believe. There are interpretations of policies and there are terms of policies. So yes, generally speaking, if a primary insurer covers something, the excess insurer could cover that as well. But it's not always necessarily the case. Just because your primary cyber insurance policy interprets your coverage one way, that does not necessarily mean that the excess insurer also has to interpret coverage that way as well. So make sure you understand what those differences are. Make sure you understand if you need to have some type of manuscript and endorsement on that excess insurance policy and what that type of excess insurance policy is, in addition to the fact that there could be additional reporting requirements or other requirements on that excess insurance policy. So, moral of the story, play by the rules, know what you're doing. You don't necessarily need to blindly trust your insurance guy with this. Do your own homework. The internet's your friend. All right, next, maybe you're going, okay, well, maybe that excess insurance thing doesn't sound so great. There's got to be a crime policy for this. I know that crime policies have big limits on them. My insurance guy goes, well, okay, if you want more coverage for these social engineering type losses, we could look at a crime policy for that. Well, it's not really that simple. What is a crime policy? Generally speaking, a crime policy is built to insure against crime. So fraud, theft, burglary, that type of issue. Now, there are other types of coverage options that are actually available on a crime policy. So you'll see something like funds transfer fraud, computer crime fraud, social engineering fraud. Hey, what's that social engineering fraud generally capped at? $250,000, probably the best you're going to get there. Next, you really need to understand limit adequacy. So make sure you actually understand what those limits are and what those terms actually mean. Not what you think what they mean, but what they're legally defined as in that specific policy. Make sure you understand that. Next, and this is probably one of the biggest issues you need to consider. You need to understand the difference between a direct loss and an indirect loss. That sounds pedantic to the extreme. Yes, it is, but if you have millions of dollars on the line, it's going to be really, really important. We're going to go through an actual court case. We're going to look at those allegations to see, to really illustrate the difference between direct and indirect loss. But suffice to say, if your insurance guy is telling you, hey, you can just get a crime policy to cover this, just get a bag of popcorn, ask him to explain the difference between a direct loss and an indirect or a consequential loss, and just sit back and for the next 20 minutes, just listen to him speak in circles, because this is a very, very nuanced, deep topic that could very well cost your business millions of dollars. And the last thing you want to do is pay for something, think you have coverage, turns out you don't. Now you wasted money and you still have this big loss you got to deal with anyways, because your insurance guy didn't necessarily understand what he was talking about. So please, please be careful in this particular area. Next, many of these crime policies come with very, very extensive rules that coverage is only afforded if very specific things are done. And if you're not playing by those rules, rest assured the insurance company could find out about that and they very well could deny you coverage. So make sure that you read that policy front to back and sideways. With that, speak to an attorney. You really need to consider doing that. These are very, very complex types of policies with very, very high limits. You don't necessarily want to just rely blindly on something being there if you don't deeply understand what's going on there. So please, if you have any questions, yes, I'm an insurance guy. I would still urge you, do not trust the insurance guy to get this right. Please speak to a qualified attorney. And if we're talking about millions of dollars here that are potentially on the line, at the end of the day, the money you're going to spend on a qualified attorney to assist you with this topic, to actually understand and, potentially advise you on if this is a good idea or not, that could pale in comparison to the cost of millions of dollars of uninsured losses for you. So definitely consider that. All right, next, let's go ahead and jump into a case to illustrate the difference between a direct loss and an indirect loss. Now, remember, I said that sounds pedantic, but it does make a difference. So these are the allegations of Apache Corporation v. Great American Insurance Company. And we're going to kind of just follow the bouncing ball here, look at this particular loss scenario, and see how this actually played out. All right, a staff member receives a call supposedly from a known vendor. That caller requests that Apache change the bank account number of the vendor. Could happen to your business pretty frequently, actually. So Apache said the request must be on the vendor's letterhead. So they're trying to follow those internal controls that they have in place. So what does the criminal do? Well, he goes, okay, great. Yep. And Apache actually receives the letter and it's on their letterhead. So then the employee, once again, I believe trying to follow those internal controls, calls what turns out to be a fake phone number that was on that letterhead to actually authenticate that it was coming from the supposedly right person there. What ends up happening, Apache wires about $7 million via their computer, to a criminal organization. Some money ultimately did get recouped from the bank, I believe. I think there was some type of internal control error at the bank, but needless to say, Apache was still out a substantial sum of money. What do? They file a claim with their crime insurer. In this case, it was Great American. Now, pertinent to this discussion, when we're talking about direct versus indirect losses, this is from the policy form there. Computer fraud damages mean a loss resulting directly from the use of any computer to fraudulently cause a transfer of that property to a third party. That's the pertinent part of that policy. So you may be thinking to yourself here, I think that would be covered. And you'd be wrong. So Great American argued that the loss was not due to direct, remember, direct versus indirect computer usage. This went all the way up to the Fifth Circuit. What do you think the Fifth Circuit actually said? They held that the email was incidental to the employee transferring funds. So from the holding of the Fifth Circuit, this is what they said. This is also in my book. You can get a free copy at the end of this presentation. In a clear warning to all businesses holding a crime policy, the court cited a previous similar ruling by holding that, quote, computers are used in almost every business transaction. Reading this provision to cover all transfers that involve both a computer and fraud at some point in the transaction would convert this crime policy into a general fraud policy, essentially covering losses from all forms of fraud rather than a specified risk category. So if we're going to boil that down, what does this mean? Big red flag. You need to speak or seriously consider speaking with qualified legal counsel before you jump into these crime policies. This, if you go back, you can watch this again. You'll probably still be just as confused as the first time you watch it. Hey, that happens to all of us, actually. I had to read through this court case like 10 times before I really, I think, got the gist of what they were talking about here. But what they're saying, when you boil it down, a crime policy is not a general fraud policy. There's a distinct difference between a direct loss and an indirect loss. And coverage may actually hinge on how that malicious third party actually perpetrated that crime and how employees were involved. It could be a big question mark there. Generally, people are not cool on paying for things that have big question marks attached to them. So please do your own due diligence there. Do not take this all at face value. And moving on. These are some additional cases that you can actually research just to prove to you that this is not just like a one-off where I'm trying to scare everybody. No, these are just some court cases. You can actually probably find these online, just kind of read through them, get the gist, a little bit deeper on the difference between a direct loss and an indirect loss as they generally deal with crime policies. Obviously, once again, speak to an attorney. With all that said, maybe you're saying, hey, I get it. I'm aware of the risks. I'm just going to buy an excess policy and a cyber policy and a crime policy to try and cover those losses. So let's buy them all. Well, it's not that easy. Don't just go trudging down that road before you know yet another fun series of facts that could put a wrinkle in this entire equation. And that would be something called MROICs. What are MROICs? MROICs are mutually repugnant to other insurance clauses. Now, how this all plays out actually even depends on the type of other insurance clauses that could potentially be in all of these types of policies. What does that mean? Well, there's different types of other insurance clauses. There's pro-rata clauses, excess clauses, escape clauses. I'm sure there's probably even other ones out there that I haven't even seen yet. But let's look at an example of how these mutually repugnant other insurance clauses come into play. And generally, I like to explain this with a scenario of homeowners insurance. So let's say you went out, you have a home, and you bought 2 different homeowners policies, each which cover the full value of that house. And then your house burns down. Do you think you're going to get twice the value of your house back in insurance? Probably not. That's a hazard that the insurance company, or the insurance industry, I should say, definitely doesn't want to promote. And neither would the legal system, actually. So how could this actually play out? Well, it just depends. As I said before, it depends on the types of other insurance clauses that you have in your policies. It depends upon what the controlling law is inside of those policies. So for example, maybe your excess policy says, hey, if there's a dispute or there's any other type of insurance here, the controlling law is going to be Texas. And then in your cyber policy, you could say Georgia. And then maybe in your crime policy, it says Connecticut or New York. And now you have all of these different court systems that could potentially come into play. And let's say you're in Nebraska, for example. So now there's a fourth potential court system there. So now it gets really, really dicey. And then you have to think about, what are the other types of insurance clauses? How is this all going to play out? How does this actually meld together? If there's a dispute, where does it go? What's the controlling law? And it just turns into a giant, giant nightmare that I don't really know if any qualified attorney could even approach a cognizant answer on this. But what I like to tell people is the following. However this works out, you need to be prepared for the fact that, one, the most you're going to get is the highest value of the policy that you have amongst all those different policies. And 2, you may end up paying all of those deductibles across all of those different policies. In practice, what does that mean? You're not necessarily getting any more insurance than you got on the first policy to begin with. Maybe you get lucky and you get all 3. But you also end up with the possibility that you could end up paying all of those different deductibles. So with that, you could now be shouldering a much bigger potential loss than you otherwise thought you were going to be covered for. So don't just think that, hey, my lowest deductible is this $1,000 deductible on my cyber policy and then I'm out of it. It's not necessarily going to be that simple. This can get very, very complex. It can get very, very technical. And generally, this is an area where if you can avoid it, you need to consider avoiding it. You can't always, kind of depending upon how your policies are structured. But needless to say, you need to be careful with what's going on. All right, let's talk about some closing considerations here. So I've been speaking potential doom and gloom this whole time. Hopefully you got some additional insights out of this particular presentation. But let's think about the following. Can you get large limits for the social engineering type fraud? Maybe you could. Maybe you could. I don't want to discourage you. Obviously, you need to do your own investigations here. You're responsible for your own business and those particular losses. I'm not providing official advice. Hey, maybe you could. So, hey, worst case scenario, you go down that path and they say no. Well, at least you know now. But maybe you could get those large limits under cyber policy. You just have to ask. But you need to consider that the insurance industry is getting very, very smart and very, very hesitant about offering large limits for very, very small premium dollars for these types of losses. So let's think about the other side of the equation here. Maybe instead of trying to dump a ton of cash into insurance, if you can even get it, look at the other side, which could be the loss prevention side. So think about those cybersecurity controls you have in place. Is there anything you could do there to lower the probability of this type of risk? Are there any type of internal payment controls that you could implement or reinforce or mandate on your staff to try and lower the probability of risk in this particular area? If so, you need to consider that. Next, employee training. I harp on this all the time. Humans are really, really great at recognizing patterns. So do everything you can to make sure that they have those patterns burned into their brains. If you're not doing, just consistent security awareness training for your employees, now is probably a good time to do that. Make sure that those employees are constantly just thinking about, okay, what's that worst case scenario? How do I validate this? What's that additional step? And you could also think about, okay, let's say at the end of the day, you only have $250,000 of insurance and you know that you're sending out amounts that are actually larger than that. Well, maybe you need yet another control in place where anything that goes out the door that's, say, above that particular limit, there needs to be yet another check on that, where yet another business owner needs to come in, go through all those controls, because the last thing you want to do is send millions of dollars out the door and potentially not have insurance for that. Finally, I'll say this. If you have a CPA firm that is qualified, you might want to consider actually having them come in as a third party, get a different set of eyeballs in this problem, and assess those payment controls as well. That might end up saving you quite a bit of heartache and quite a bit of uninsured loss there as well. And then finally, I'm just going to say it again, speak to a qualified attorney to assist you with all of this. I was not giving any sort of official advice. I'm just giving you some ideas and considerations and topics for you to think about before you start going down this path. So at least you have an educated basis to start asking the right questions of the right people. All right, with that, if you enjoyed this presentation, this is Damage Control, Cyber Insurance and Compliance. That is where you can go to download a free copy of my book. If you enjoyed this presentation, please warn your fellow business owners. Like, share, comment, subscribe, feeds the algorithm. We can get this out to more people. And with that, stay safe.